to evolve a scheme to enlarge the use of bills. Based on the scheme suggested by the study group, the RBI introduced with effect from November 1, 1970, the new bill market scheme in order to facilitate the rediscounting of eligible bills of exchange by banks with it. To popularize the use of bills, the scope of the scheme was enlarged, the number of participants was increased, and the procedure was simplified over the years. The salient features of the schemes are as follows. Eligible institutions. All licensed scheduled banks and those which do not require a license, i.e. the State Bank of India, its associate banks and nationalized banks, are eligible to offer bills of exchange to the RBI for rediscount. There is not objection to a bill accepted by such banks being purchased by other banks and financial institutions, but the RBI rediscounts only such of those bills as are offered to it by an eligible bank. Eligibility of bills. The eligibility of bills offered under the scheme to the RBI is determined by the statutory provisions embodied in Section 17(2)(a) of the Reserve Bank of India Act, which authorize the purchase, sale and rediscount of bills of exchange and promissory notes, drawn on and payable in India and arising out of bona fide commercial or trade transaction, bearing two or more good signatures, one of which should be that of a scheduled bank or a state cooperative bank and maturing. In the case of bills of exchange and promissory notes arising out any such transaction relating to the export of goods from India, within 180 days, 270. B. In any other case, within 90 days from the date of purchase or rediscount exclusive of days of grace. C. D. E. The scheme is confined to genuine trade bills arising out of genuine sale of goods. The bill should normally have a maturity of not more than 90 days. A bill having a maturity of 90 to 120 days is also eligible for rediscount provided at the time of offering to the RBI for rediscount it has a usance not exceeding 90 days. The bills presented for rediscount should bear at least two good signatures. The signature of a licensed scheduled bank is treated as a good signature. Bill of exchange arising out of the sale of commodities covered by the selective credit control directives of the RBI have been excluded from the scope of the scheme to facilitate the selective credit controls and to keep a watch on the level of outstanding credit against the affected commodities, and the following types of bills are acceptable to RBI for the purpose of rediscount. I. Bills drawn on and accepted by the buyer's bank. 2. Bills drawn on buyer and his banker jointly and accepted by them jointly. 3. Bills drawn on and accepted by the buyer under an irrevocable letter of credit and certified by the buyer's bank which has opened the letter of credit in the manner specified by RBI, that is, that the terms and conditions of the letter of credit have been duly complied with by the seller. IV. Bills drawn on and accepted by the buyer and endorsed by the seller in favor of his bank and bearing a legend signed by a licensed scheduled bank which should endorse the bill, confirming that the bill will be paid by bank 3 days before the date of maturity. V. Bills drawn and accepted in the prescribed manner and discounted by a bank at the instance of the drawee. Where the buyer's bank is not a licensed scheduled bank, the bill should additionally bear signature of a licensed scheduled bank. 17.9 Reasons for non-development of bill market in India. Although RBI has taken various steps to activate bill market, but there are some reasons due to which it has not been developed fully. Some of reasons are being enlisted here. 1. If a bill is dishonored, then it is expected to get prompt legal remedy. It has been noticed that procedural delay creates problem in this regard. 271. 2. Bill market requires strict commitment to honor financial obligations on the agreed date, but it has been observed that government and industries are not ready and serious in this regard. 3, 4, 5, 6, 7, 8. Cost of credit facility is comparatively low in comparison to cost of credit through bill discounting. There is no uniformity in the documents to avail bill discounting facility. Absence of reliable credit information causes delay in the approval of new customers. Bills are not accepted within a reasonable time frame, which causes delay on the part of drawee. Delay in remittance of proceeds by the bank. Buyers are scattered in various parts of the country. 17.10 Measures to encourage bill market. The RBI has introduced several measures to encourage bill market. Some of these measures are being explained here under 1, 2, 3, 4, 5, 6. RBI in 1981 allowed mutual funds to participate in bill rediscounting market. Rediscounting procedure in respect of bills below the face value of Rs 10 lakhs has been simplified by dispensing with the actual lodgement of bills. If bills of exchange is payable in not more than 3 months and drawn in favor of a cooperative bank or a commercial banks, the Govt of India has provided the facility of remission of stamp duty. The commercial banks which are licensed scheduled have been permitted to rediscount bills with some financial institutions approved by RBI, Unit Trust of India, UIT, General Insurance Corporation of India, LIC are the examples of such financial institutions. The RBI set up the Discount and Finance House of India Limited, DFHI, to develop secondary market for commercial bill. It has been set up jointly with all India financial institutions and public sector banks. Commercial banks are free to charge market-determined interest rate on bills. Interest rates applicable on discounting of bills have been delinked from the prime lending rates of banks for this purpose. 272. 17.11 Summary. In modern business scenario, there are a lot of credit transactions take place. In the situation of credit sales, the seller wants a written commitment from the purchaser to pay the amount of goods on particular date. As a written commitment, bills of exchange is issued. These are properly written and stamped documents. On the basis of the bill of exchange, banks make payment to the party and maturity date collects payment from the buyer. For this, banks charges some amount of discount, and this facility is known as bills discounting. Bills of exchange may be of different types, i.e. demand bill, usance bill, documentary bill, clean bill, etc. Bill discounting facility is beneficial both for investors as well as to banks. For investor it is a cheaper, easy, flexible, short-term source of finance, and for banks it is a safe and higher discounting charges scheme. But for safe bill discounting, banks should follow some points like signature should be verified, credit limits must be sanctioned, etc. For the development of commercial bill, an active instrument in the secondary market, the Reserve Bank of India has set up several committees and schemes, i.e. Dahijia Committee, Tandon Committee, Chor Committee, Vagal Committee. Bill Market Scheme 1952, Bill Market Scheme 1970, 17.12 Self-assessment questions, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. What is bill of exchange? Who are the parties to a bill of exchange? Who is drawer? What is demand bill? Define usance bill. Name the parties of a bill of exchange. What is documentary bill? What is meant by clean bill? Explain about the different types of bills. What is bill of exchange? Explain different types of bills. What is bill discounting? Explain the advantages of bill discounting. Explain the reasons for non-development of bill market in India. 17.13 Reference books. M. Y. Khan, Financial Services. Jain, Roddy,